Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, June 9th, and I'm recording this from my office in Purchase, New York. Since the April sell-off around tariff trauma, both the S&P 500 and the NASDAQ are up more than 20%, qualifying as a new bull market. At this point, it's important to understand the underlying thesis of this bull market, especially given that regardless of what actually happens with tariffs, the market seems to view them as old and manageable news. Indeed, the current narrative seems to ignore potential tariff-related concerns, while focusing on a number of other factors: an economic soft landing, the promise of stimulus and Federal Reserve cuts, and there's also hope of a capital spending boom driving material productivity gains and earnings growth acceleration in 2026, even as this year's growth estimates have been meaningfully reduced. While the market-implied scenario is plausible, we think it's somewhat premature and may be resting on a shaky foundation, with investors seeking only limited risk premiums despite significant unknowns. First of all, aside from the uncertainty related to tariffs, the summer is likely to bring significant debate on the increasingly contentious choices around the tax bill, the debt ceiling, and bank regulation. And then there's the market's blind eye to increasingly unstable geopolitics. Consider that in recent weeks, Netanyahu's leadership in Israel has been jeopardized by fractions in his governing coalition, calling into question peace in Gaza. Ukraine has executed an audacious drone attack deep inside Russian territory, followed by Russian retaliation, and progress on the Iranian nuclear deal has stalled. Meanwhile, the bull case seems to be built on several assumptions, and they include expectations for earnings growth, profit margins, and capex and productivity gains. Here we see a lot of hope without actual hard foundational evidence. For one, investor confidence is not being echoed by business leaders. The second quarter Conference Board CEO survey showed the biggest drop in the history of the series. This doesn't exactly suggest that companies are looking through 2025 and promising re-accelerating prospects in 2026. Also embedded in the estimates for next year's earnings is an assumption of margin expansion in 2026. But margins overall are likely to face pressure from weaker productivity and higher unit labor costs. Another margin proxy, the spread between prices received and prices paid, is also currently running negative, with recent ISM manufacturing and services surveys surprising to the upside on input cost gains. Finally, current dynamics on capex are not encouraging. Durable goods orders are running negative, and new order indices for manufacturing and services are in a contraction. None of this acknowledges cracks in the services sector, a slowing labor market, and an increasingly stressing consumer. We understand that markets are anticipatory, but the current rally still seems to be struggling with a credible narrative. Against this backdrop, investors should pay attention to valuation multiples, which are again expanding, and consider active stock picking versus relying on the passive index. Position your portfolios for average equity returns, which we forecast around 5 to 10% this year, in an environment of more volatility, higher real rates, and a weaker U.S. dollar. Look to diversify with international equities, commodities, energy infrastructure, and hedge funds. Lastly, staying overweight in short to neutral duration investment grade bonds as well as municipals still makes sense. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.